You may have heard that the return most investors get in a given mutual fund is less than what is published by the mutual fund. Why is that? And why can the Secure Act 2.0 actually help you increase your personal rate of return? To learn how you can do that, stay tuned to this week's episode of the Retirement Income Source, where it truly is all about the income. And welcome to the Retirement Income Source, where it truly is all about the income. I'm David Scranton, here with Sarah Samuels. And yes, today we're going to talk about how you can control your personal rate of return, not the one published that's theoretical by the fund family or the investment company, but your personal rate of return, what you experience on your money based upon what you contribute and what you can withdraw. And also why the Secure Act 2.0 might just help you increase your personal rate of return. So, Sarah, do I have your curiosity piqued?
You do, Dave. It almost sounds too good to be true. So I want to hear this. But first, I want to welcome all of our listeners and, of course, our YouTube viewers into the show. We are so happy that you're choosing to spend your weekend with us or whenever you're watching the show on YouTube. So, Dave, tell us why or how can you control your own rate of return here?
That's all I am, is an object to you, huh? That's all you do.
You're like a crystal ball.
You just care about my knowledge.
Yeah.
You want to know how I can help you get more rate of return. You don't care about me as a person.
Aww.
You don't care about the fact that my in-laws have been down here staying with me now to get out of the cold for the last 2 weeks. You don't care about any of that, do you?
Dave, you didn't mention any of that. Your in-laws are down. I'm glad that they're here.
Yeah, it's we're so grateful to be down here where it's 80 degrees, high temperature, and the days are a little longer and everything. And I know a lot of you are stuck up in this long month of January, which is rough. It's this long, cold month, and February's shorter, but not much better. So, but anyways, great to have you with us here today. And yes, I love having my in-laws here, and they got a great chance now to retire to get out of the cold and come down here for a couple weeks in this long, cold month of January.
Yeah, it's really nice to get a break, especially down here in South Florida. It's kind of like taking a vacation. So I'm sure they're happy to be here enjoying this warm weather and really out of the cold.
Yeah. So you can control the environment that you're in, the temperature that you're in, and to some degree the length of the day, right? Days here are about an hour longer than they are up north, maybe 2 hours. You also can control your rate of return in a given fund. Again, that popular statistic that mutual funds, Sarah, will quote a certain return over a certain period, but the return that most investors get is a lot lower. And the reason is because of the timing of their contributions and withdrawals. They make the contributions at the wrong time after things have run up. So they buy high and they take their withdrawals at the wrong time when things have sold off and gone down. And that means that their personal rate of return is a lot less than the published rate of return of the fund. But what a lot of people don't know is mathematically, like you said, it sounds too good to be true, right? And I know some of our listeners are thinking about that. But mathematically, just contributions help increase your personal rate of return. Mathematically, distributions hurt your personal rate of return. And it might not be what you're thinking and why you're thinking it. It's more than that. But that's what we're going to talk about here on today's show, Sarah.
All right, Dave. Well, I think it's time to get into our Ask Dave segment here. We have a question from Kelly in Minnesota. Kelly says, I'm still in my 30s, but how do I know if I have the right allocation in my 401k for retirement?
Right.
Dave?
Well, Kelly, that's a great question. And I'll answer that, but I will also say that what's more important than your allocation is that you're saving as much as you can and you're doing it on a regular basis. Because, Kelly, part of the point of our show today and why contributions are so helpful in increasing your personal rate of return is because by contributing regularly, you are dollar cost averaging, which means that in the months the market's down, in the weeks the market's down, if you get paid weekly, you're putting more money in. You're essentially buying more shares with the same amount of money. In the months the market's up, you're buying fewer shares with the same amount of money. So you're getting your average purchase price, and mathematically you're pushing your average purchase price down because you're buying more shares when the price is low, fewer shares when the price is high. The average cost per share is down. So the most important thing you can do is keep doing it. Do not stop. A lot of people, when the markets do what they did last year, they get discouraged. They say, gosh, my 401k balance is going down even with all the money I'm putting in. I'm wasting this money. I could be spending it and enjoying it, and I'm putting more money in my account balance is still going down. I'm just going to stop. And that, Kelly, is the worst thing that you can do. As far as your allocation, stay tuned because I'm going to talk to you in just a minute about a story about somebody I had come in that was just about your age just yesterday in my office. And I want to share a story with you about what I told her, and that will answer that second part of your question.
All right. Well, Kelly, thank you so much for sending in your question. And if any of other listeners or YouTube viewers out there want Dave to answer one of your questions, all you need to do is email us at askdave@theretirementincomesource. That's SOURCE.com. You're listening to the Retirement Income Source, where it truly is all about the income. And today we're talking about the effects of contributions and distributions on your 401k and ways that you can really control your rate of return, your own personal rate of return, with the way that you contribute and distribute from your fund. So, Dave, you kind of gave us a little tease there with Kelly's question, but I want to hear. Tell me about this client yesterday that came in their 30s that had questions for you about allocating their retirement assets.
Well, yeah, and it's rare that I meet with somebody that age, but
right.
it was
it's kind of out of the age range for who you really talk to mostly.
Oftentimes, yes. And she knows this, and she's 40. Well, I don't know if she's listening. I would say 40 or 41, but she might be listening. So I'm just going to say 40. She was 40, right?
29.
And came in with some money that she wanted to invest, just cash, right? And we talked about all, because as a fiduciary, right, Sarah, I have to talk about all the alternatives and the different risks and how the textbook would say if you're that age and this is retirement money, you want to be a little more aggressive, you want to be in the markets. But still, it may not be a bad time to look at bonds because interest rates have come up. And the headwind we had with bonds in the last year could turn into a tailwind. So we talked about all that. And thankfully, at the end, she decided, I'm young enough. I just want to be more aggressive. So we went ahead and we did something that was aggressive. But then she went on to asking about some of her retirement plans from work. And I think she was a little surprised because most financial advisors, even in, let's say retirement plans where you've left, will try to take over that money and try to invest it so they could charge fees on it, right? And if I invested that I could charge fees on it. And she was with a generic mutual fund family. But the point is that I just looked at it and said, these two funds right here look good. And it was kind of a knee-jerk reaction. It wasn't as analytical, let's say, as when we talked about what she's going to do with us. And I think maybe at first she looked at me kind of funny, like, well, is he taking this seriously? Or why is he not trying to take over this? This is extra revenue for him. But the reality was that when you're that age and you retire 20 or 30 years out, it doesn't matter as much. If you're in a decent stock fund and you're in it over the long run, and I say stock funds because you have a 20-year horizon, you should be mostly stocks, right? And your dollar cost averaging, that is the most important thing you could do. So it wasn't so much that, okay, maybe our fund is a little bit better than their funds, but the fact that the funds were good, they were decent, and the most important thing is the strategy, because what will affect her rates of return over the next 20 years more than anything else isn't the fund itself, it's the fact that she's consistently putting money away and she's dollar cost averaging, buying more shares when the market's down, fewer shares when the market's up.
Well, that's right, Dave. When you're younger, when you're in your 30s and 40s, I've heard you say this, you have time, right? You have time to recoup any of those losses that you might face in the stock market. But it's a different story when you really pivot to those transition years and when you're going into retirement.
Yeah, it really is. And the funny thing here is that, when you're younger, your dollar cost averaging has a huge benefit because you're contributing a bigger amount every month on a percentage basis relative to the balance, right? But as you get older, my age or older, hopefully you've accumulated a much bigger balance. And the government limits how much you can contribute. So as a result, the dollar cost averaging effect starts to diminish as you get older. But coming up, I want to share with you how you can increase that dollar cost averaging effect. So you can essentially reverse aging in your portfolio, right? Popular topic these days, reverse aging, by having a similar dollar cost averaging benefit in your 50s or 60s that you did when you were in your 30s.
All right. Well, I can't wait to hear it. I'm Sarah Samuels, and I'm here with David Scranton, and you're listening to the Retirement Income Source, where it truly is all about your income. You're listening to the Retirement Income Source, where it truly is all about your income. I'm Sarah Samuels, and I'm here with our host, David Scranton, and today we're talking about ways that you can actually influence the rate of return by the way that you contribute and distribute from your accounts. And just a few minutes ago, Dave was kind of teasing us here, right, with this reverse aging idea that you can actually reverse age your portfolio and that you can actually see some of the same benefits that you saw from dollar cost averaging back in your 20s and 30s. You can get those benefits later in life. So Dave, please explain.
Yeah. I mean, look at you, for example, right? You look great for 53 years old. Absolutely great. Right now, I'm sure people watching the podcast, watching the video are saying, wow, I can't believe she's 53. That's amazing. And I'm sure some of our listeners on radio too are wondering now how I can get that podcast, how I can watch this. So we'll have to tell them later how they can actually get on there and see us record the show. But aging is a natural process of the human body. Just last week, I read an article where this guy who's 35 years old he spends $2 million a year on doctors and on medicine, and it's all to reverse his aging so that every organ goes back to where it was at age 18. And the theory is that you grow until a certain age, around age 18, and everything after that declines and goes backward, right? So if you're a male watching this, your testosterone peaks maybe at age 18 and declines after that. Heck, you can't even turn on the television without seeing commercials for low T, right?
Right.
And that's the same in your portfolio. Your portfolio naturally ages, right? We need to work out less strenuously as we get older because
you don't want to throw out a hip, right?
That's right.
Hurt
It's all fun and games till somebody breaks a hip. That's right. So you got to tune it down as you get older, just like you have to tune down the risk in your portfolio as you get older. It's really no different. And the dollar cost averaging effect naturally deteriorates, right? When you're younger, you might have $50,000 in an account. You're putting in $10,000 a year. Well, your dollar cost averaging effect is huge because you're putting in 1/5 of the balance every year. You get older, if you're fortunate, you might have $2 million. And if you're putting in $20,000 a year, now you're not putting in 20% anymore, you're putting in 1%. So it naturally declines and deteriorates as you get older, right? Your portfolio does, just like the human body. No surprise, right, Sarah?
Right, yeah, no surprise. And it makes sense because when you're younger, you really don't have that nest egg savings yet as opposed to when you're older. Plus, when you're younger, you have more time that you can spend in the market as opposed to when you're in retirement.
You do.
So what's the solution, Dave? Tell us.
So first of all, the new Secure Act takes for certain older workers and allows them to contribute a little bit more. That helps a little bit, but not a ton. But the biggest thing that you can do, Sarah, is to invest for dividends. Even if you want to stay in the stock market, invest for dividends. Dividends will increase your dollar cost averaging effect. So let's say you have $1 million. Let's use a round number.
Okay.
You're putting in 20 grand a year. You think, okay, my dollar cost averaging is 2% of the balance, right?
Sure.
But now if you have a 4% dividend on your stock portfolio, now you're putting in 20 grand, but you're also reinvesting 40,000 of dividends every year. Now you have a 6% dollar cost averaging effect. So even if you want to stay in the market, just by how you stay in the market will help you. Yeah. And if you just do the math, there's all these arguments over what's better, dividend stocks or growth stocks or anything. Well, Sarah, my crystal ball has been broken for years. I don't trust it, right?
Right.
But mathematically, dividend stocks are more valuable. So if the total return on a growth stock and a dividend stock are the same, what most people don't realize is the dividend stock will give a higher return to the client because of that dollar cost averaging effect. If the total return's the same, the dividend stock will do better for you. Because again, dollar cost averaging is a way to increase your personal rate of return.
All right, so let's get into our Ask Dave question. We actually have this question here. Brian from Colorado. Brian is saying, Dave, what are some common mistakes that you can avoid when approaching retirement?
Okay, Brian. Well, unfortunately, we only have an hour for the show, so I'm not sure how we're going to cover all this, so stay tuned. But one of the most common mistakes people make when they approach retirement is they still try to exercise too hard. They try to do what they did 30 years ago, and they injure themselves. They try to invest the way they did 30 years ago, and they injure their portfolios, in part by taking too much risk, and in part by not having enough yield. We always talk about going from a total return focus to an income focus. And Brian, an income focus doesn't mean you need to give up total return. It just means that you need to focus on getting more of that total return from income. So stay with us because I want to talk later in the segment, Brian, about some specific things that people do to mess up their personal rate of return when they're in those final years, when they're in that red zone approaching retirement.
Yeah. Brian, you don't want to miss that, so keep on listening. And if you're listening to the show and you want to send Dave one of your retirement questions, all you have to do is email us at askdave@theRetirementIncomeSource. That's SOURCE.com. Yep. And you might just hear Dave answer your question on a future episode of the show. You're listening to the Retirement Income Source, where it really is all about the income. My name is Sarah Samuels, and I'm here with Dave Scranton. And today we're talking about ways that you can actually influence your rate of return return, ways that you can reverse age in your portfolio by using dividend stocks to dollar cost average more effectively.
Yeah.
And Dave, you also mentioned just a little while ago about risk tolerance and why risk is such a huge thing. Can you tell us a little bit about how you can really determine what your risk tolerance is?
Well, part of it is just gut feel. You have to ask yourself, okay, if I have $1 million in my portfolio, how low can that portfolio go?
Yeah.
Before all of a sudden it's too painful for me psychologically when I lose sleep, right?
Yeah. When I'm
then,
anxious,
and then you can stress test it. You can go back. For example, in our office, we have a computer software which allows us to stress test it. Go back and say, okay, if you were in this portfolio in various times in past history, how much would you have lost? So just like they started stress testing the banks after the financial crisis in '08, you can stress test your portfolio and see if there are times when the losses would have exceeded what your comfort level is.
Yeah.
So that's the personal side of it. The other side of it is how far you are from retirement. And most financial advisors won't talk about this. I talk about math all the time because there's things
you love math.
Yeah, there's things that are crystal ball, right? Things that are, well, I think this will do better than that. And everyone's got an opinion, right? Opinions are just like, blank.
You can't say it on the radio.
Like blank, everyone has one, right? But the reality is that when it comes to math, there's some things that are true. And first of all, for the same return, like I mentioned before, for the same return, all else being equal, a portfolio that has a higher dividend and a little less growth will outperform one that has more growth and no dividend for the same total return, because the dividends give you a dollar cost averaging effect, which helps you. Okay, and again, that's because think about dollar cost averaging as toothpaste, right? There's a lot of things in life that work good in one direction, but they don't work well in the other, right? So toothpaste works great when you're trying to push it out.
Coming out of the tube, not so good going back in the tube.
That's right. So when you're dollar cost averaging, it helps you. It lowers your rate of return. When you lowers your average price, increases your rate of return. When you're reverse dollar cost averaging, pulling money out every month, you're actually lowering your sales price. So you're decreasing your rate of return. So, that's mathematical. Okay. So the reason I share that is because Brian's question, we some of the mistakes you make. Well, okay, if you're in that red zone within 10 years of retirement, the first mistake you can make is leaving money in the 401k if you have an opportunity to roll it over. Now, if you've left an employer and switched, you can roll over your old 401ks typically once you've gone. If you're still working at a company, there are a lot of companies that allow you to in-service rollovers as early as age 55, if not at age 59 and a half. And the reason for that is because a lot of the options inside a 401k typically don't have high dividend options. They don't have options where you can use those dividends to successfully dollar cost average.
Yeah.
Now, it's even worse, Sarah, if Brian were to get into retirement and he were to start actually withdrawing money from the 401k, because now he's reverse dollar cost averaging. Now he's trying to put the toothpaste back in the tube.
Right, and we know that doesn't go so well.
That doesn't work well. That's right, because now he's selling more shares when the market's down.
Right.
Now, some advisors who have limited tools in their toolbox, and they're not really income specialists, they don't know how to generate interest and dividends, they'll use a tool called variable annuities. Okay. Now, I don't want to sound like Susie Ormond or Ken Fisher, and I don't want to pretend all annuities are bad, because whenever somebody says all of X is good or all of X is bad, to me, you shouldn't listen to those people, right?
You should be wary of that.
They're too extreme. Yep. Everything in moderation is a place for just about everything. Where I have a difficulty finding the right place is with this thing called a variable annuity. So a lot of brokers who are growth specialists, not income specialists, will have variable annuities in a portfolio. And basically, they're like a 401k. They're a bunch of mutual funds. Yeah. And people withdraw when they get into retirement. And then they put an expensive insurance wrapper on there that says, well, if you run out of money, well, we're going to pay you for the rest of your life. And that's great that your income never stops. But if you're paying a 3, sometimes 4% fee, it's almost impossible for you to make money. So coming up, I want to talk more about some mistakes. I want to talk about why making that transition from growth to income might be the right thing to do earlier than most of our listeners actually think.
All right. Well, Dave has the magic formula, and you're going to hear about it next. I'm Sarah Samuels, and I'm here with Dave Scranton, and you're listening to The Retirement Income Source, where it truly is all about your income. Welcome back to the Retirement Income Source, where it truly is all about the income. I'm Sarah Samuels, and I'm here with my good friend Dave Scranton, and today we're talking about ways that you can personally influence your rate of return on your investments. And just a few minutes ago, Dave was telling us why now might actually be a good time to make that pivot, depending on where you are and how close you are to retirement. So, Dave, can you tell us why, and also why most advisors aren't really talking about this transition time?
Yeah. And it's all about anti-aging. I mean, I think that not only do people want to anti-age, not only do you look not a day older than your early 30s, given you're 53, right?
Oh yeah, look great for my age.
And that's right. And you know how you need to anti-age your portfolio, but you also have to anti-age your advisor's thinking, because Sarah, part of the problem is the advisor's thinking and how they're set in their ways. And the biggest problem is advisors are trained to do something one way, but they're not trained to listen to their clients. And I'm going to pick on my part of the species for a minute, the male part, right? Because men just don't listen. They don't listen.
Hey, you said it, Dave, not me, okay?
But 90% of financial advisors are I just hurt my ratings by 50%. I know, we did.
You brought us down
But
there.
no, guys, admit it, right? We don't listen that well, right? And you're going, huh? What'd he say? The reality is that women are much better listeners, but fewer than 10% of financial advisors are women. So men are trained to do something a certain way, and they don't listen. That's a big part of it. For example, right? Most people, when they retire, and we talked about this before, do they cash out their money in a lump sum and go spend it all and buy something? Or no. They use it to generate what?
Income.
Use to generate income.
Right.
Okay. So, and they tell their advisor that, and frankly, their advisor should know that. Number two, if I would ask you, what would you rather build a plan on? What you hope is true, or what you reasonably know will be true, right? What do you think most of our listeners are going to say, Sarah?
I think most people want to build their life plans, especially with something as important as retirement, on something they know to be true.
That's right. But advisors do the opposite. So how are we taught to project this? Okay, let's say you take me, I'm 57, right? And I went to a financial advisor and said, I've got $1 million. I want to retire in 10 years. How much income can I get in 10 years? Well, what that person is going to do, most likely, is project forward some growth assumption. And let's say they assume 7% growth, right? Well, just as a number, right?
Yeah.
Just pulling out of the air.
Sure.
Because it works cleanly that at 7% over 10 years, my $1 million would grow to $2 million. My money would double, right? Then at that age, you're going to figure out, okay, how much income can Dave take from the portfolio? And let's say we convert it to more income-generating investments right on the brink of retirement. And let's say that number's 4%. Well, now if my $1 million grows to $2 million in the next 10 years, it'll generate 4% or $80,000 a year of income, right? But there's two problems with that. And they're all based around the fact the advisor didn't listen to what the client wanted, okay? The client said, first of all, this is here to generate income. So, Sarah, do you ever wonder why that advisor would go and take the time to calculate what the lump sum is going to be worth if these people don't plan to cash it out in a lump sum?
Right. What's the point of that?
What's the point?
Yeah.
It's because they were taught to do it that way. But even more egregious than that is that, you as a listener know that you want to build a plan based upon what you know is likely to be true, not what you hope is true, right? And that 7% growth rate, do we have any level of certainty that we're going to get a 7% average total return over the next 10 years?
No, we don't.
If you made that assumption in the year 2000, right, 10 years later in 2010, your money would have been underwater. If you were in the S&P 500, the broad-based stock market, my $1 million would have been worth about $800,000. I wouldn't have been able to retire. So again, they don't listen. And that's my biggest concern, is they just don't listen to the client. And they do what they were trained to do, not the right way to calculate the numbers. And I want to share that right way actually in a little bit.
All right, Dave. Well, I think that's a perfect segue actually into our Ask Dave question. So this question comes from Doug out in Florida. Doug says he recently watched an episode.
Out in Florida?
Here in Florida.
Here in Florida, yeah.
I forgot where we
Here
were
in
for a
Florida.
moment. Here in Florida. So Doug was telling us that he watched an episode on American Greed. He recently watched the Bernie Madoff series, which I actually recently watched too. He says the SEC...
I know where this is going.
And the SIPC seem to be incompetent, if not corrupt, by not having sufficient safeguards in place to guard against this. So what steps has your firm taken to safeguard your portfolios?
Great question. And, it's and this is Doug, right?
Doug, yes.
Well, Doug, you certainly dug into the information and the hard Facts. Yeah, I'm so old I got the dad jokes, and I'm not even a dad. Can you believe that?
Oh gosh, Dave,
So-
don't quit your day job.
So, Doug, I want to make a big difference in your mind to understand the difference between a hedge fund like what Bernie Madoff had and a registered investment advisory firm. As a registered investment advisory firm, we and lots of other firms around the country are fiduciaries. Okay, they have to put their clients' needs first. So I know Ken Fisher likes to pretend on his commercials he's the only fiduciary in the universe, the whole world, including Alaska and Hawaii, that puts the client's interest first. But really, there are a lot of us out there. And see, as a fiduciary, we can't take your money. Bernie Madoff, as a hedge fund, could and did. So he took your money, he invested it in one account on his own. You didn't get any direct statements from a third party. Instead, he would create those statements, which means that he was able to falsify the statements and send you whatever he wanted. And yes, the SEC could have looked closer with him, and if they had, they would have seen this. The SIPC isn't really involved because he's not a member of the SIPC. He doesn't have to be as a hedge fund person. But yes, the SEC could have looked closer and looked into that, and they failed. But a registered investment advisor has a separate account. For example, we clear through TD Ameritrade, Schwab, Fidelity. Your money is at a big firm different from us, right? And what that means is that even if we had a complete thief on our staff, and I hope we don't, they could not go in and withdraw money from your account. There's no authorization to withdraw money. So again, a registered investment advisor is much different from a hedge fund, and there are protections built in place. Unfortunately, to some degree with hedge funds, it's a little bit of the buyer beware.
Yeah. All right. Well, Doug, thank you so much for sending in your question. And I hope that helped. I hope that helped answer it. If any of our other listeners or viewers out there want to ask Dave your question, all you need to do is email us at askdave@theretirementincome source. That's SOURCE.com. You're listening to the Retirement Income Source, where it truly is all about the income. I'm Sarah Samuels, and I'm here with our host, Dave Scranton. And today we're talking about ways that you can personally influence the rate of return you're getting, the ways that you can reverse age your portfolio with some dollar cost averaging methods, including getting dividends. We've also talked about why now is really a better time to pivot really to income than it might have been before. Just one note on Doug, the Ask Dave question from Doug. I actually watched the Bernie Madoff documentary too, and I have to say there was one part where he almost got caught, right? When the SEC, he gave them, I believe it was his clearinghouse number, and if they had just run that number, the whole jig would have been up, right? Yep. He would not have gotten away with it until the recession hit, I think is what really did him in.
The financial crisis.
The financial crisis, yeah.
So could the SEC in retrospect have done better? Yes. Did they have their egg on their face?
Absolutely.
Yes. But again, the question, I like to talk in the show, Sarah, as you know, about what you can control, right? What our listeners or our podcast viewers can control. And what you can control is not messing around with hedge funds. Unless you're ultra wealthy and you have a little bit of money that you can just risk, don't mess with hedge funds. Deal with investment advisors, registered investment advisors who are fiduciaries who have to put your interest first. And as I said before, I know all the Ken Fisher commercials like you to think that they're the only ones that are fiduciaries, and really a lot of the investment world truly is.
Right.
But here's the difference. We talked about how the problem is most advisors don't really listen to their clients. What we didn't close the loop on, though, is why investing for income 10 years or more out is so important, right? And here it is. Yes, that advisor is correct. That advisor is correct that if everything goes well and that million grows to 2 million, and I can get 80,000 a year 10 years from now when I retire. But if they're wrong and those assumptions are wrong and the market goes down and I have 800,000, and let's say I'm in the S&P 500 getting a 1.5% dividend, now at 800,000, I only get a $12,000 dividend. So Sarah, if that advisor were being completely honest with me as a prospective client, that advisor would be saying, Dave, you become a client of mine. I want you to hand all your money over to me. And I assure you that your retirement income 10 years from now is going to be somewhere between $12,000 and $80,000, right? Well, if that advisor were that brutally honest with me or any prospective client, would he be able to get any clients?
I mean, $12,000 to $80,000, $12,000 versus $80,000. That's a huge range, Dave.
Right.
Huge swing.
So, and coming up, I want to talk about why, again, mathematically, why that's the wrong way for people to plan who are in that retirement red zone, but also mathematically, why going from total return focus to income focus as much as 10 years earlier or more is the right answer.
All right, all that and more coming up in just a few minutes. I'm Sarah Samuels, and I'm here with David Scranton, and you're listening to the Retirement Income Source, where it truly is all about the income.
And welcome back to the Retirement Income Source, where it truly is all about the income. I'm David Scranton. I'm here with Sarah Samuels, and today we're talking about how to anti-age your money, how your money naturally deteriorates as you get older in terms of risk, how the dollar cost averaging benefits, which is a really good thing, diminish as you get older, but most importantly, how the Secure Act can help you restore a little bit of that dollar cost averaging youth to your portfolio, and more importantly, what you can do, but through interest and dividends, to restore it on your own. We also talked about how one of the major mistakes people make later in life when they're retired or even getting that red zone near retirement is keeping their money in 401ks for too long and keeping their money in things like variable annuities.
Yeah. In addition to that, Dave, we mentioned, you mentioned really advisors are not listening to their clients, and that if they were offering a true projection of growth, it would show something like $12,000 a year all the way to $80,000 a year, which is not going to work for most people. So explain, Dave, why does it make sense mathematically to make this transition earlier?
All right. So again, you want to build a plan that's going to be for income, because most of your retirement money is there to generate income, right?
Yes, that paycheck, right, when you've left the workplace.
That's right. You want to build a plan based upon what you know is reasonably likely to be true versus what you hope is true, right? So here's what we know. We know that if you're in the S&P 500 at a 1.5% dividend, we know that if you have, like I said, if things go backward like they did from 2000 to 2010 and your million drops to 800,000, we know you've got a $12,000 dividend at retirement. And if your goal is 80,000 and you end up with 12, guess what? You ain't retiring, right?
Right. Right. Not on 12,000.
But what if you increased your dividend today? What if you got it up to 4.5%? Which you can do. And now all of a sudden, what you know is you're getting 45,000 from the portfolio. Right now, we don't have a clue. I don't have a clue. My crystal ball is broken, like I said earlier in the show. No advisor has a clue as to what that money is actually going to be worth, the portfolio is going to be worth. But they know the income today is 45,000, right? Yeah. And they know that that income is sticky. It's very sticky in bonds and preferreds. It's contractual. But even in common stock, diversified portfolios, over time, the dividends typically go up, not down. Companies don't like cutting dividends. It's bad for their stock, right? So what we do know is if we reinvest that $45,000, that will grow by 4.5% each and every year, right? So for your engineer types listening, you could take out your HP 12C, right? And you can calculate what is 45,000 compounded at 4.5% growth over 10 years. Well, the answer is it's about $70,000. So we know that your income, by reinvesting that $45,000, it'll grow at 4.5% a year for 10 years, thereabouts. It'll end up at about $70,000 of income, give or take 1,000 or two. Okay. Now, Sarah, if I were to ask our listeners, and we were to take a poll here, if you're going to retire and you want option A, you're going to get anywhere between $12,000 and $80,000 per year of retirement income, option A. Or option B, you're going to get $70,000, give or take $1,000 or two. You think anybody's going to take option A?
I mean, unless they're really living on the edge, Dave, I think everyone's going to want that $70,000, almost guaranteed.
And this isn't being a math genius. I haven't studied math in 35 years. And frankly, my math was my undergraduate degree, and I got straight Bs, right? Not A's, not 4.0. It didn't happen. But my point is that I listen to the client. The client says they want to build a plan upon what they know is likely to be true, and they know the dividends are likely to be true, not some crazy growth assumption that I hope is true. And I also know that they want to use this to generate income. Because they want to use to generate income, we focus on the income, and I don't even waste my time trying to calculate the lump sum, because neither I nor anybody else knows what that lump sum is going to be worth.
Right.
And that, Sarah, is why making the transition from being total return focused to income focused, doing it as early as 10 years or more before retirement, mathematically is a better deal. But you know what? You're not going to hear that from any financial advisor anywhere, hardly.
Yeah, but you're going to hear it from David Scranton right on this show, of course. So let's get into our Ask Dave question. It goes right with this topic. So we have Erin from New Mexico, and she writes in, she says, what are some strategies for creating a steady stream of retirement income?
Yeah. Well, great question. And, in general, the strategy is, you're getting close, is going mentally from this total return focus to the income focus. And we talked about how if you have enough money and you want to stay in the stock market, focusing on higher dividend stocks, because in the years leading up to retirement, at least those high dividend paying stocks can increase your dollar cost averaging, therefore increase your personalized rate of return, right? But then when you decide you want to retire, and sometimes it's on a whim, sometimes not even our choice, we get laid off, right? Or we just decide, I'm fed up with this, I want to leave. You take those dividends you're reinvesting, you call your income specialist and say, give me those dividends in cash, and your income stream automatically just turns on, right? So that's one way to do it. But there's also other ways to do it in this world called, bonds and bond-like instruments that maybe people didn't talk about up until recently because the yields, the interest rates
Didn't
on
make
bonds
sense,
were
yeah.
so low. And I disagree. We were able to get good interest rates, but most average retirement planning advisors didn't know how to do that. Only true income specialists did. So I think I want to spend more time a little bit later on the show just wrapping up, what some of those good things are to do in the world of bonds and bond-like instruments if you retire. And you rightfully so don't want to have all your money in the stock market, even if it is high dividend stocks.
Absolutely. And why it's so important, of course, to work with an income specialist when you're nearing this part of your life. So, Aaron, thank you so much for sending in your Ask Dave question. And if anyone else wants Dave to answer your retirement question, all you need to do is email us at askdave@theretirementincomesource. That's SOURCE.com. You're listening to The Retirement Income Source, where it truly is all about the income. I'm Sarah Samuels, and I'm here with Dave Scran as we're wrapping up today's show, discussing ways that you can reverse age your portfolio, that you can influence your own personal rate of return on the money that you're getting. So, Dave, talk a little bit more about why you need to work with an income specialist and specifically all the other parts that go into this income pie, if you will, right? Like Social Security, a pension, those kinds of things.
Because a growth specialist is going to be crystal ball oriented. I think these stocks will do better than those. I think bonds will do better than stocks. Stocks will do better than bonds. And it just doesn't work. The smartest people on Wall Street are right only maybe 60% of the time, which means there's a 40% chance that your advisor's crystal ball is broken. It's not going to work. A true income specialist focuses on the math. And we talked about a lot of math today, how dollar cost averaging helps you anti-age your portfolio and helps you increase your personal rate of return relative to what the actual investments are doing because you're buying more shares in the markets down, fewer shares in the markets up. How reverse dollar cost averaging, leaving money in 401ks or variable annuities too long and taking systematic withdrawals, selling principal, actually lowers your personal rate of return. That's a bad strategy.
Right. You end up buying high and selling low. The opposite.
A true income specialist is going to look at the math, and just like the math we just gave as to why making the transition from being total return focused to being income focused 10 years or more away from retirement can be the right strategy for most people. And that's the beauty about this universe of bonds and bond-like instruments, Sarah, is somebody hires an income specialist. They don't have to rely on a crystal ball to say this is going to do better than that because bonds are very mathematical, right? If you're analyzing a bond, when you buy a bond, you're lending money to a company, right? So really that income specialist acts as a credit analyst, like a bank would if they're approving your mortgage. They look at financial ratios and they make a decision based upon math. So as long as there's no bankruptcy by the company that issued the bond, and I always say knock on wood, I'm going to knock here, okay? And they can't hear it, I don't think, on the microphone. But if you knock on our fake wood here on our studio, you find that we've never had a default in a bond, for example, because it's very mathematical, it's very scientific. And that doesn't mean it won't happen, right? But I know exactly what you'll get if you buy a bond, you hold it to maturity, assuming there are no defaults. Again, math. The same is true with something called preferred stocks, because preferred stocks pay a high dividend. That's contractual, right? And they have a par value or a face value where if they get redeemed by the issuer, then they get redeemed at a fixed price. So those are things that are very mathematical. And again, it's not reliant on an advisor's crystal ball. And, up till now with interest rates being down, even though we've really known where to look in the markets to get better bonds, better preferreds and things like that, a lot of advisors haven't. But now with interest rates being higher, virtually any income specialist now can look at the bonds and preferreds and get you a far higher return in the form of the interest and dividend, not the growth. Remember, total return is two components. TR equals I plus G. Total return equals income plus growth. And all you can really count on is the I component, that income component, that bird in the hand. And a true income specialist can help you with that. And again, because bonds and preferreds and bond-like instruments are very mathematical, it just makes it really easier, and it makes an investor like our listeners, Sarah, feel confident that they're going to hit that retirement goal within a very narrow range versus the dreaded difference between $12,000 and $80,000 a year of retirement income.
Bottom line, Dave, what is your best advice for our listeners and our YouTube viewers out there that are heading into retirement or getting close to retirement?
Best advice is, hey, pay attention to our show every week. Every week you'll be able to learn something about it. And that's the thing about knowledge. You can't just do a brain dump and you can't put a whole encyclopedia set in your brain overnight. Knowledge comes over time. You've got to digest it in chunks. And our listeners and our podcast viewers and listeners have the ability 52 times a year to learn in little bits and pieces.
Yep. And you can also go and visit our podcast website. It's retirementincomesourceradio.com, where you can listen to this episode and all of our past episodes. Hey, you can even share it with your friend if you like Dave's advice, and give them a little tip there. So please visit retirementincomesourceradio.com.
Yeah. And please share it with your friends. We really would appreciate that. But most importantly, we're very grateful. Right, Sarah?
Oh, we are.
We're grateful that you're here with us today. And we look forward to having you join us again next week. I'm David Scranton here with Sarah Samuels, and this is the Retirement Income Source, where it truly is all about the retirement income.